I've spent 3 weeks pulling apart how the ultra-wealthy actually move money, and one number stopped me cold. Private credit has grown into a multi-trillion-dollar market that most retail investors have never even heard of. Not because it's hidden, because the door was locked. Before I show you how that lock is breaking, I need something from you. Somewhere in the next several minutes, you're going to have a question, a real one, the kind you'd ask a private lender if you ever got them in a room. Don't sit on it. Drop it in the comments while it's fresh, because I read every single one, and the best questions become the next video. This channel isn't a broadcast, it's a conversation, so let's actually have one. Now, let's talk about the bank. Not your bank specifically, the idea of a bank. The building with the marble floor, the velvet rope, the loan officer who smiles at you for exactly 4 seconds before sliding a stack of paperwork across the desk. For most of your life, that institution has been the only door into capital. You wanted to buy a home, you walked through that door. You wanted to expand a business, same door. You wanted yield on your savings. You took whatever interest rate they decided to offer you that quarter, usually somewhere between insulting and barely keeping up with inflation. Here's what almost nobody tells you. The wealthiest families in the world stopped walking through that door decades ago. They didn't find a better bank. They stopped needing one. This is the part where I tell you what Wealth Forge actually is for anyone new here. We don't follow the market. We design the moat. In a world of followers, we are the architects of our own freedom. That's not a slogan I picked because it sounded good on a thumbnail. It's the entire operating philosophy of this channel. Every video here is built on one premise. The financial system was not designed by accident. Someone architected it. And once you understand the blueprint, you stop being a passenger inside it and you start building your own structure beside it. Private credit is one of the clearest examples of that blueprint I have ever come across. And by the end of this video, you're going to understand it better than most financial advisors do, because most of them were never trained on this corner of the market in the first place. Their licenses, their compliance frameworks, their entire professional world was built around public stocks and bonds. This sits outside all of that. So let's take it apart, piece by piece, slowly, and build the full picture together. Strip away the marketing, the mahogany furniture, the friendly commercials with families buying their first home. A bank is a middleman. That's the whole function. It takes your deposit, pays you almost nothing for the privilege of holding it, and then lends that same money out to someone else at a much higher rate. The spread between what they pay you and what they charge the borrower, that spread is the entire business model. It funds the buildings, the executive salaries, the shareholder dividends. All of it traces back to that one spread. Sit with that for a second. You are functionally an unpaid employee of your bank. You're doing the riskiest part of the job, handing over your capital, and they're keeping the majority of the reward. If you walked into a job that paid you 0.5% for your labor while your employer kept the rest, you'd quit by lunch. Most people don't even know they're in that arrangement because it was never explained to them as an arrangement. It was just presented as how money works. You get a debit card, a mobile app with a nice interface, maybe a toaster if you're old enough to remember when that was a thing, and in exchange, you hand over the use of your capital for next to nothing. For most of modern history, this was simply how lending worked because banks controlled the infrastructure. They had the branches, the underwriting systems, the regulatory relationships, the sheer scale required to evaluate and fund a loan. If you wanted to lend money to a hospital system building a new wing or a logistics company financing a fleet of trucks, you needed a bank to do it because you personally did not have the apparatus to underwrite that risk. You didn't have a credit team. You didn't have legal counsel specializing in secured lending. You didn't have the relationships to even get in the room with that borrower. That barrier is gone now, and almost nobody has updated their mental model to reflect it. I want to take a brief detour here because understanding how we got here makes everything that follows make more sense. Go back further than 2008, back to the early 20th century. For most of that era, lending to businesses was actually a fairly direct relationship. Local banks knew local business owners. Insurance companies held loans directly on their books for decades at a time, collecting interest the way a landlord collects rent. The system was smaller, slower, and in many ways more personal. A bank president in a mid-sized town might have personally known the owner of the lumber yard he was lending to, understood the seasonality of that business, and structured the loan around it accordingly. There was no algorithm. There was relationship-based underwriting, for better or for worse. What changed across the back half of the century was scale and securitization. As the economy grew and capital needs grew with it, the relationship-based model couldn't keep pace. Banks realized they could bundle loans together, package them, sell them off, and free up their balance sheets to make even more loans. This innovation wasn't inherently reckless. Bundling and reselling loans is, in principle, a reasonable way to spread risk and unlock more capital for the economy. The system became more efficient at moving money to where it was needed. But efficiency and complexity aren't the same thing, and over decades, the layering compounded. This is part of what eventually contributed to the complexity that blew up in 2008. Layers upon layers of bundled debt, sliced and diced and resold so many times that almost nobody at the top of the chain actually understood what they owned anymore. That collapse in trust and transparency is precisely what triggered the regulatory response that followed. After 2008, something changed that most people never noticed because it didn't happen on the news. It happened in regulatory filings nobody outside finance reads. Basel III, Dodd-Frank, a wall of new capital requirements that made it expensive and risky for traditional banks to hold certain kinds of loans on their balance sheets, especially loans to mid-sized companies, real estate developers, and infrastructure projects that didn't fit neatly into a standardized lending box.
Regulators, understandably, wanted banks to be safer. Fewer risky loans sitting on their books, more capital held in reserve. From a systemic stability standpoint, that's a reasonable goal. Nobody wants a repeat of 2008, but it had a side effect that almost nobody outside the industry talks about. So banks did what any rational, risk-averse institution does when the rules change. They pulled back, quietly, no press release. They started saying no to exactly the kind of lending that used to be their bread and butter, the unglamorous, asset-backed, cash flow-generating middle market. The mid-sized manufacturer that needed 5 years of financing to expand a facility, the regional developer who needed a bridge loan, the renewable energy project that needed capital before its first dollar of revenue ever showed up. But here's the part that should genuinely surprise you. The demand for that capital didn't shrink by a single dollar. Companies still needed to build things. Infrastructure still needed financing. Real estate projects still needed bridge loans. The need was sitting right there, fully intact, screaming for capital. And the traditional supply had just quietly stepped back from the table. Into that gap walked private credit. Private credit funds are, in their simplest form, pools of capital, often from pension funds, endowments, family offices, and increasingly accredited individual investors that lend directly to companies and projects, completely outside the traditional banking system. No branch, no teller, no middleman taking the spread. The lender and the borrower transact directly, with the fund manager structuring the deal, setting the terms, and collecting the yield that used to belong entirely to the bank. You are no longer the depositor earning crumbs. In this structure, you can be the lender. Read that sentence again because it's the entire thesis of this video. Think about the shift in posture that represents. As a depositor, you're passive. You hand over money, you hope the bank does something reasonable with it, and you accept whatever rate they hand back. As a lender, even an indirect one through a fund, you're active. You're not hoping the system works in your favor. You're occupying the exact seat that used to belong exclusively to institutions with billion-dollar balance sheets. Now here's where it gets interesting, because not all private credit is created equal, and this distinction is the one that separates an informed investor from someone who just heard a buzzword at a dinner party and wants to sound sophisticated at the next one. I want to zoom in on one corner of private credit that deserves more attention than it gets, because this is where the recession-resistant characteristic really starts to show up, and it's the part of this market that most retail-facing content skips entirely in favor of flashier, riskier corners of private credit. Think about what infrastructure actually is. Toll roads, power grids, water treatment facilities, data centers, telecommunications towers. These are not discretionary purchases. A toll road doesn't stop generating revenue because consumer confidence dipped for a quarter. A power grid doesn't see usage collapse because of a stock market correction. People still need electricity in a recession. They still need water. They still need their data to move, recession or not, headline or not, panic or not. Now compare that to lending against the luxury retail chain, where revenue can evaporate the moment a downturn hits and people tighten their spending overnight. Same label, private credit.
completely different animal underneath. This is exactly why blanket statements about an entire asset class are almost always misleading. Private credit is a category, not a strategy. Inside that category, you'll find everything from conservative asset-backed infrastructure lending to aggressive unsecured lending to early-stage companies that behaves more like venture debt than anything resembling a bond. Infrastructure cash flows are sticky. They're contracted, often for decades, with built-in escalation clauses tied to inflation. The lender isn't betting on whether people will want the product next year. They're lending against something society has no real choice but to keep using. That's why family offices have leaned into infrastructure debt as one of the more resilient yield sources through multiple market cycles, including periods when public equities were getting hammered on the front page. Let me give you a sense of scale here, because numbers without context don't mean much. Think about a toll road financing a refinancing of its existing debt. That project might have committed traffic projections backed by decades of historical usage data, contracts with the state government, and revenue that's been stable enough to model with real precision. Compare that to a venture-backed startup that might not exist in 3 years. Both could technically be called private lending. Only one of them has the underlying stability that makes the recession-resistant claim actually hold up. Let's get concrete on the mechanics now, because vague enthusiasm isn't useful to you, and I refuse to waste your time with vague enthusiasm. A private credit fund identifies a borrower, let's say a renewable energy company building out a portfolio of solar farms with already signed long-term power purchase agreements. The fund extends a loan secured against the physical assets and the contracted cash flows. Because this loan sits outside the traditional banking system and because it requires sophisticated underwriting that most lenders aren't equipped to do, the borrower pays a premium for that capital compared to what a public bond might yield. That premium is often called an illiquidity premium, compensation for the fact that, like a publicly traded bond you can sell in 3 seconds, this loan can be instantly liquidated. You're committing capital for a defined period, usually several years, in exchange for a meaningfully higher yield than comparable public market debt would offer. This is the exact trade the ultra-wealthy have been making for years. They give up same-day liquidity, and in exchange, they capture the spread that used to belong entirely to the bank sitting in the middle. I want to be precise about something because I take this seriously, and you should be skeptical of anyone who doesn't say this part out loud. This is not easy money. This is not a loophole that requires no skill. Underwriting private credit deals well requires real expertise, evaluating the borrower's cash flows, the quality of the collateral, the legal structure of the loan, the experience of the fund manager running the vehicle. The wealthy families who do this successfully are not doing it alone. They're working with specialized fund managers and advisors who have spent careers building underwriting infrastructure that an individual investor simply cannot replicate from a spreadsheet on a Tuesday night. So here's the honest question you might be asking right now. If this requires that much expertise, how is this video relevant to you at all? Because what's changed is not the mechanism, it's access.
Until recently, these funds had minimums that genuinely locked out anyone who wasn't already wealthy. $5 million, $10 million buy-ins were common, full stop, no exceptions. That wall is coming down. Interval funds, certain business development companies, and evergreen private credit vehicles have started opening this asset class to accredited investors at dramatically lower minimums than a decade ago. The door isn't fully open to everyone yet, but it's open further than it has ever been in modern financial history. And that's worth pausing on, because access to an asset class shifting even partially is the kind of structural change that, looking backward in 10 years, people will point to as an obvious inflection point that almost nobody paid attention to in real time. The families who got there early didn't have some secret nobody else could access. They simply paid attention to a structural shift while it was still quiet and positioned themselves before everyone else noticed it was happening. Now, let's talk about what can actually go wrong here, because an honest video has to include this, and most content on this topic conveniently leaves it out. Private credit is not without real risk, and the resilience I've described is a tendency, not a guarantee. Default risk doesn't disappear just because a loan is asset-backed. It's reduced, not eliminated. A borrower can still mismanage a project. A contracted cash flow can still get renegotiated or disrupted if the counterparty itself runs into trouble. An infrastructure asset can still be poorly built, poorly maintained, or located in a region that faces unexpected regulatory or environmental challenges down the line. There's also a structural risk specific to how these funds are built. Some private credit vehicles use leverage themselves, meaning the fund borrows money to amplify its own lending capacity. That can boost returns in good years and magnify losses in bad ones. This is exactly the kind of detail that gets buried in page 40 of a fund's offering documents, and it's exactly the kind of detail an architect reads before committing capital, not after. And then there's valuation risk, which is subtle but important. Because these loans aren't publicly traded, they don't have a daily market price the way a stock does. Fund managers typically use internal models to estimate value between transactions. That means the reported value of your investment can lag reality, for better or worse, until an actual liquidity event, a sale, a refinancing, a maturity, reveals what the asset was truly worth all along. This is one of the reasons due diligence on the manager matters as much as due diligence on the underlying loans themselves. None of this means avoid the asset class. It means understand it completely before you enter it. The wealthy families who've used private credit successfully for decades did not get there by ignoring these risks. They got there by pricing them correctly and structuring around them deliberately. Let me walk you through a realistic scenario, because abstract risk is easy to nod along to and easy to forget 5 minutes later. Picture a private credit fund that's lent against a portfolio of mid-sized commercial properties, office buildings in secondary cities, fully leased, generating steady rental income that comfortably covers the loan payments on paper. For years, this looks exactly like the recession-resistant asset-backed lending I've been describing. Then the world shifts in a way nobody fully priced in. Remote work becomes permanent for a meaningful share of office tenants. Lease renewals start coming in at lower rates or don't come in at all. The contracted cash flow that looked so stable in the original underwriting starts eroding, not because the loan was poorly structured, but because the world the loan was underwritten in no longer exists in the same form. This is exactly why I told you to scrutinize the collateral type, not just the word asset-backed. Real estate is physical, yes, but its cash flows are tied to leases that renew, expire, and renegotiate based on shifting demand. Toll roads and power grids have demand that's far more structurally locked in than office space does. The label infrastructure matters more than the label asset-backed alone, and conflating the two is exactly the kind of mistake that turns an informed investor into a disappointed one. A well-run fund manages this kind of shift by diversifying across borrower types, by stress-testing loans against scenarios like this before they're ever made, and by structuring loan covenants that give the lender real leverage if cash flows deteriorate, the ability to step in, renegotiate, or, in worst cases, take control of the underlying asset before the situation worsens further. A poorly run fund simply hopes the world changes. That difference, almost entirely invisible from a marketing brochure, is the difference between a fund that protects your capital through a difficult cycle and one that doesn't. This is precisely why the manager due diligence I mentioned a moment ago isn't a formality. It's the single highest leverage piece of homework in this entire asset class. So, how does someone actually begin thinking about this responsibly rather than just chasing a headline yield number? Here's the exact framework I'd want you to walk away with. Write these 4 down if you need to, because this is the part of the video that actually protects you. First, look at what's actually backing the loan. Is this asset-backed lending against hard infrastructure with contracted cash flows? Or is this unsecured lending to a company whose revenue depends entirely on consumer mood? Those are 2 completely different risk profiles wearing the same label. Ask specifically what collateral exists and what happens to that collateral if the borrower defaults. Second, understand the liquidity terms before you commit a single dollar. Private credit is not a savings account. Capital is often locked up for years. If there's any chance you need that money back on short notice, this is not the vehicle for it. The yield premium exists specifically because you're giving up liquidity. Know exactly what you're trading away before you trade it. Read the redemption terms line by line. Some funds offer quarterly liquidity windows with caps on how much can be redeemed at once. Others offer none at all until the fund's stated term ends. Third, scrutinize the manager, not just the fund. A mediocre manager underwriting infrastructure debt can turn a theoretically resilient asset class into a genuinely bad outcome. Track record, default history through prior cycles, and whether the manager has their own capital in the deal, these matter enormously, and they're exactly what most marketing materials gloss over in favor of a clean, confident pitch deck. Ask how the fund
fund performed specifically during 2008 and specifically during 2020 if it existed then. A manager's performance during calm markets tells you almost nothing. Their performance during chaos tells you everything. Dig further than the headline track record, too. Ask how many loans in the fund's history actually went into default and what the recovery rate looked like when they did, meaning when a borrower failed to pay, how much of the original capital did the fund ultimately
Recover through collateral seizure or restructuring? A fund that's never had a single default in 15 years isn't necessarily a sign of skill. Depending on the strategy, it can just as easily be a sign the fund hasn't lived through a real stress test yet, or that the loans were structured so conservatively that the yield being marketed to you doesn't reflect any meaningful risk being taken at all. You want a manager who can speak candidly about the deals that went wrong, not just the ones that went right. Candor about past mistakes is, counterintuitively, one of the strongest signals of a manager worth trusting with your capital. Fourth, understand fee structures completely. Private credit vehicles often carry management fees and sometimes performance fees that public bond funds simply don't have. Your net yield, after fees, is the only number that actually matters. The headline number on a marketing deck is not your number, never has been. A fund advertising an attractive gross yield can quietly hand you a meaningfully lower net return once management fees, performance fees, and fund expenses are subtracted. This is the same blueprint thinking that runs through everything on this channel. We don't chase a yield because it sounds impressive in a headline. We architect a position because we understand exactly what's structurally holding it up. Let's talk practically about what actually starting this process looks like, because a framework without a first step is just theory. The starting point isn't writing a check, it's confirming whether you even qualify. Most private credit vehicles available to individual investors require accredited investor status, generally defined by income or net worth thresholds set by securities regulators. That's the first gate, and it's worth checking before you spend hours researching a fund you may not currently be eligible to access. If you're not there yet, that's not a dead end. It's simply information that tells you where to direct your energy for now, whether that's elsewhere in your portfolio or toward the income and asset growth that gets you to that threshold over time. From there, the realistic entry points fall into a few categories. Publicly traded business development companies, BDCs, are the most accessible, since some trade on public exchanges just like a stock, giving you liquidity that direct private funds don't offer. The trade-off is that you're often getting a diluted version of the illiquidity premium, since public market pricing tends to compress some of that extra yield. Interval funds sit in the middle, less liquid than a BDC, more liquid than a fully locked-up private fund, typically offering quarterly redemption windows with caps. And then there are the evergreen private credit vehicles built specifically for accredited investors, which tend to offer the fullest expression of the illiquidity premium in exchange for the least flexibility. None of these is universally better. They're different points on the same spectrum, trading liquidity for yield in different proportions. An architect doesn't ask which one is best in the abstract. An architect asks which one matches their actual time horizon, their actual liquidity needs, and their actual risk tolerance, because the honest answer for one person can be the wrong answer for another, even when they're looking at the exact same fund. Once you've identified the category that fits, the real work begins, reading the offering documents, not the marketing summary. Specifically, look for the fund's stated investment strategy and confirm it actually matches what you think you're buying. A fund that markets itself around infrastructure lending should be able to show you exactly what percentage of its portfolio sits in infrastructure versus other types of private credit. If that breakdown isn't clearly disclosed, that itself is information about how transparent that manager is willing to be before you've committed a single dollar. Talk to a financial advisor who has actual experience with alternative investments, not just public markets. This is not a corner of finance where a generalist's intuition reliably transfers. The underwriting standards, the legal structures, the fee mechanics, all of it differs meaningfully from the public stock and bond world most advisors were trained in. Ask directly whether they have specific experience evaluating private credit managers, and don't be shy about asking for examples. And give yourself permission to start small and build conviction over time. Nothing about this asset class requires you to deploy your entire investable net worth on day one. The wealthiest families didn't build their private credit allocations overnight either. They built them deliberately, fund by fund, manager by manager, over years of accumulated experience watching how different managers performed through different conditions. There's no reason your approach should look any different just because you're starting later in the timeline than they did. Here's the bigger picture, and it's the part I actually want you to remember after you close this video, long after you've forgotten the specific mechanics of illiquidity premiums and power purchase agreements. For most of modern financial history, capital formation, the actual process of deciding which companies, which infrastructure project, which parts of the economy get funded, has been controlled by a small number of large institutions. That concentration of decision-making power is itself a moat that mostly excluded ordinary people from sitting on the right side of the lending relationship. Not because ordinary people lacked the intelligence to understand lending, because they lacked the access. Private credit, for all its complexity and all its real risks, represents a crack in that moat. It's one of several developments, alongside fractional real estate, tokenized assets, and direct infrastructure investing, slowly redistributing access to the lending side of the economy, instead of just the borrowing side most people have only ever experienced. You've spent your whole financial life on one side of this equation as the depositor, the borrower, the customer. Private credit is one of the clearest on-ramps to standing on the other side of that table. It's not the only one, and it's not without real homework required before you step through that door. But it is, structurally, a door that simply did not exist for ordinary investors a generation ago. That's the entire thesis behind everything we build here, not follow this hot tip. Architecture, understanding the structure underneath the system, and then deciding, deliberately, where you want to stand inside it. Now, here's where I actually need you. I've laid out the mechanism, banks pulling back, private credit filling the gap, infrastructure lending offering that recession-resistant cash flow profile, the real risks that come with all of it, and the framework for evaluating a deal like an architect instead of a speculator. But I know there's a question sitting in your head right now that I haven't answered. Maybe it's about minimums, maybe it's about how actually find a reputable fund, maybe it's about what happens to your capital if the borrower defaults. Maybe it's something I haven't even thought to cover.
Whatever it is, put it in the comments below. I'm not asking for engagement to please a platform. I'm asking because the single best videos on this channel have come directly from questions this community asked me. You ask the sharpest questions I get anywhere, and the next deep look at private credit is going to be built directly from what you post below this video. Comments aren't just numbers to me. They're the blueprint for what we build next, together. If this gave you a clearer picture of how the wealthy actually generate yield outside the banking system, subscribe, because we're going much further into this world in the coming weeks. Fund structures, how to vet a manager, real numbers on what these vehicles have returned through past downturns. We don't follow the market. We design the moat. And in a world of followers, we are the architects of our own freedom. I'll see you in the next